Hello and welcome to today's Delta Credit Tip. So you're trying to buy a home and now you're hearing all these terms and vocabulary you're not familiar with. Well, today we're going to go over 10 terms that you're going to want to know going into this contract so that you understand what you're getting into. So stay tuned, we're going to fill you in on today's Delta Credit Tip. Hello and welcome back to today's Delta Credit Tip. I'm Michael Holmes of Delta Credit Restoration, bringing you yet more information to help you in your credit restoration process. So today we're going to talk about all these terms that you're going to hear in the course of buying your home. So we want you to understand this vocabulary because that means you're going to have a better understanding of what's being said around you, obviously, and you'll be able to then determine whether or not you're actually getting what you think you're getting. All right, so these 10 terms we're going to give you, hopefully you'll find it helpful. If so, give us that thumbs up. Don't forget, subscribe and hit the bell so that every week as we come out with more information to help you in your credit restoration process or home buying process, you get this information as we give it and it helps you right away. All right, so let's talk about term number 1. This is kind of one of my pet peeves. I'm going to be honest with you because when I talk to people a lot of times, they say this word, but they obviously are kind of misunderstanding it. So the first term I want to go over is debt to income ratio. Now, a lot of times when I hear people say this word, they'll say my debt to ratio. It's a debt to what ratio? There's got to be a other side of the equation because it's a ratio. On the ratio, you have one side on the equal side and one thing on one equal side and one thing on the other side of the equal side, right? So your debt to income ratio is your payments that you are making that are on your credit report divided by your income. Okay? It doesn't have to do with the light bill, doesn't have to do with the water bill, doesn't have to do with the cable bill. And even though you might be paying Experian to boost your score, it doesn't include the utility bills and all that stuff that you're putting on there. Okay? But the reason why this number is so important is because typically on a mortgage, they're going to cap how much of your income can be going towards your debts. Because otherwise you'll be choking yourself out financially if you just keep building and building and building small monthly payments, right? So the debt to income ratio, that's what that is. Now, a very similar ratio is the debt to credit ratio. Now, this is the number that will keep you from getting your mortgage when your credit is good, okay? Because a lot of times people confuse having good credit with the score, and it's not, because if you have a high debt to credit ratio, your score is not going to make it, okay? So what is a debt to credit ratio? This is the balance on your credit cards divided by the limit on your credit cards, typically notated by a fraction or actually a decimal, less than 1, right? You have a $1,000 credit card, you have a $200 balance on that credit card, you have a 20% debt to credit ratio. Now, if you have a $1,000 limit, or let's say a $100 limit, and a $105 balance, well, now your debt to credit ratio is 105. Definitive no-no, okay? So you're going to want to really ask your lender what that debt to credit ratio that they're looking for. Typically, we tell people 20% because once you go above 30%, your score starts to suffer, all right? The third number, or the third term that we want to go over, again, is another ratio. And this is what they call loan to value. Now, when you're trying to buy your house or even a car, a lot of times the loan to value can determine your rate. With FHA mortgages, it can, with conventional mortgages, it can determine whether or not you have to pay private mortgage insurance. Another definition we'll get to in just a second. But the loan to value is the loan that you have on your house divided by the value. So again, we want that number to be low. All right, you don't want a high loan to value ratio because you want to have equity. You want to have more value than what the house is worth. And that becomes very important when it comes time to sell that house. Because obviously if you sell a house that you owe more than what it's worth, now you have problems, right? Because you're going to have to bring money to the table. But that is your loan to value. Another term you might hear, the fourth term that we're going to talk about, is called points. Where they came up with the word points is beyond me, because really 1 point equals 1 percentage rate. That's it. I mean, why they call it points and make life complicated for everybody, I don't know, but points are percentage rates. And usually when you're talking about points, you're really talking about paying interest up front. So if you buy a point, you're buying 1% up front, and it reduces the interest rate, the annual percentage rate that you have over time. Okay, but points are really just interest, right? 1 point equals 1% interest. So we talked about rate a second ago. The annual percentage rate. I want to go over what the annual percentage rate is. So there's a difference between an annual percentage rate and a rate, or you might hear it as an APR. The difference between the two is the rate is typically what they call a stated rate. Hey, I'm stating I'm charging you 4%. But by the time I put in there mortgage fees, origination fees, whatever fees that I'm charging you as a lender to get that loan or maintain that loan, you may find that your rate is actually 4.25 or an eighth higher or a half a point higher, because they're adding in all those fees in the annual percentage rate, which they will not necessarily state in the rate itself. All right, but typically a mortgage lender is going to quote you the annual percentage rate and the rate so that you understand, that you know what the two are. Okay. The next is term. All right, so whenever you get a loan, there is a term that loan works under. Now, a credit card has no term because it's ad infinitum. It'll live forever if the lender stays in business and you pay it on time. But a term is typically associated with a loan that has a definitive beginning and a definitive end. And that time duration from start to finish is called the term. So on mortgages, typically you have a 30-year term. Or if you want to save money or the life of the loan, you might go for a smaller term, like a 15-year term loan. Okay, but the term is how long you keep a loan. All right. Now, for the people borrowing the money, you could have a co-borrower, which is the same thing as a co-signer. What it is not is an authorized user. The biggest difference between a co-signer or a co-borrower and a authorized user is that an authorized user is not liable for anything. They're not also contributing to what will ultimately determine whether or not you actually get the loan. A co-borrower or a co-signer have a definitive impact on whether or not you're going to actually qualify for that loan. All right? Next term we're talking about is gross versus net income, number 8. So your gross income is what you make before taxes, before health insurance, before your HSA account, before anything is taken out. You make $10 an hour, you work 80 hours a week or 80 hours every 2 weeks, that's $800. That's your gross income. Now, once they take out the taxes and all that other stuff, then you have what gets deposited into your account every week or biweekly or however, and that's your net income. All right. Number 9. This is homeowners insurance. The reason why I want to bring this up is because there's actually 2 types of insurances that you can get for your home. One is homeowners insurance, which you're going to basically have to buy to cover the structure of your home. It protects against things like fire, right? It protects against things like the tree falling on your house. It protects you against the guy that cracks his head on the concrete because he slipped on a banana, right? But if your water heater goes out and next thing you know, you got water pouring down the driveway, or your dishwasher explodes, or your air handler goes out, these things can be covered with what they call a homeowner's warranty insurance, which covers the things on the inside of the house. And this is something that we typically recommend that our customers buy because it may cost you $50 a month, but it sure as hell beats $3,000 to buy an air handler when that goes out. Because you know it's going to go out right after, you know, the water heater blows or the dishwasher blows out or the garbage disposal comes to it. And it never happened in ones, right? So that insurance can keep you from having to pay that huge dollar amount that may create that bad credit spiral. All right. Last but not least, I want to go over private mortgage insurance. Now, private mortgage insurance is insurance that the bank will demand that you have to protect them. It in no shape, form, or fashion protects you. As a matter of fact, what happens is if you default on your loan, then the lender can file a claim with their insurance company with the private mortgage insurance and get some help because you defaulted on the mortgage, but yet they still come after you for the entire amount that you owe, right? So it absolutely does nothing for you. It only helps the bank. And the only way that you're going to be able to avoid private mortgage insurance is through a conventional mortgage. So if you want to avoid that $100, $200, $300 a month of insurance that you're going to have to provide in private mortgage insurance, then you're going to want to talk to your lender about getting a conventional loan. All right. So there you have it. We've got 10 terms that you're going to definitively hear when you start to do your mortgage. Hopefully you find that information helpful. If so, again, give it that thumbs up. Don't forget to subscribe and hit the bell so that every week as we come out with more stuff, you get it as we give it, because we do this every week, people. We do it every week. So come on back next week. And in the meantime, make a choice, make a change. Delta.